This video is for revision of advanced audit and assurance. And this is the mock exam 3. We have question 1. This is the detail of question. You are a manager in the audit department of Business Co., a firm of chartered certified accountants responsible for the audit of Eagle Group, which has a financial year ending 31st December 2018. Your firm is appointed to audit the parent company, Eagle Co., and all of its subsidiaries, with the expectation of Linco, a newly acquired subsidiary located in a foreign country, which is audited by a local firm of auditors, Voucher Associates. All companies in the group report using IFRS standards as the applicable financial reporting framework and have the same financial year end. You are provided with the following exhibits. 1. An email which you have received from Maya Crack, the audit engagement partner. Number 2. Background information about the group, including a request from the group finance director in respect of a non-audit engagement. 3. Extracts from the group financial statements projected to the 31st December 2018 and comparative extracted from the management accounts and accompanying explanation notes. 4. Management determination of goodwill arising on the acquisition of Linco. 5. An extract from the audit strategy document prepared by Voucher Associates relating to Linco. Respond to the instruction in the email from the audit engagement partner. Note the split of mark allocation is shown in the partner's email. Professional marks will be awarded for the presentation and logical flow of the briefing notes and clarity of the explanation provided. Exhibit 1. Email from the audit engagement partner. To audit manager from Maya Crack, audit engagement partner. Subject: audit planning for the Eagle Group. Hello, I have provided you with some information in the form of a number of exhibits which you should use in planning the audit of the Eagle Group. I held a meeting yesterday with the group finance director and representatives from the group audit committee, and we discussed a number of issues which will impact on the audit planning. Using the information provided, I require you to prepare briefing notes for my use in which you A. Evaluate the audit risks to be considered in planning the group audit. You should use analytical procedures to assist in identifying audit risks. You are not required to consider audit risks relating to disclosure, as it will be planned for later in the audit process. B. Design the principal audit procedures to be used in the audit of the goodwill arising on the acquisition of Linco. Management's calculation of the goodwill is shown in Exhibit 4. You do not need to consider the procedures relating to impairment testing or to foreign currency retranslation, as this will be planned later in the audit. C. Using the information provided in Exhibit 5, evaluate the tracks of the audit strategy prepared by Voucher Associates in respect of the audit of Linco and discuss any implications for the group audit. D. After considering the request in Exhibit 2 from the Group Finance Director in respect of our firm providing advice on the group's integrated report, discuss the ethical and professional implications of this request, recommending any further actions which should be taken by our firm. Thank you. Exhibit 2. Background information about the group and requests from Group Finance Director. Group operational activities. The group, which is a listed entity, operates in distribution, supply chain, and logistics management. Its operation is worldwide, spanning more than 200 countries. The group's strategy is to strengthen its market share and growth revenue in sustainable manner by expansion into emerging markets. There are over 50 subsidiaries in the group, many of which are international. There are three main business divisions: post and parcel delivery, commercial freight, and supply chain management, each of which historically has provided approximately one-third of the group's revenue. The fourth business division, which focused purely on providing distribution channels for the oil and coal sector, was established 2 years ago, and in 2008 began to grow quite rapidly. It is forecast to provide 12% of the group's revenue this year, growing to 15% in 2009. This division is performing particularly well in developing economies. In recent years, revenue has grown steadily, based mainly on growth in some locations where e-commerce is rapidly developing. This year, revenue is projected to decline slightly, which the group attributes to increased competition, as the new distribution company has taken some of the group's market share in a number of countries. However, the group management team is confident that this is a short-term drop in revenue and a forecast a return to growth in 2009. Innovation. The group has invested in automating its warehouse facilities, and while it still employs more than 250,000 staff, many manual warehouse jobs are now performed by robots. Approximately 5,000 staff were made redundant early in this financial year due to automation of their work. Other innovations include increased use of automated loading and uploading of vehicles, and improvements in the technology used to monitor and manage inventory level. Integrated report. The group is proud of this innovation and is keen to highlight these technological developments in its integrated report. The group finance director has been asked to lead the project task with producing the group's first integrated report. The finance director has sent the following request to the audit engagement partner. We'd like your firm to assist you in developing our integrated report and to provide assurance on it, as we believe this will enhance the creditability of the information it contains. Specifically, we would like your input into the choice of key performance indicators which should be presented, how to present them, and how they should be reconciled where relevant to financial information from the audited financial statement. The publication of an integrated report is not a requirement in the jurisdiction in which the group is headquartered, but there's a growing pressure from stakeholders for an integrated report to be produced by listed reporting entities. If these accept the engagement in relation to the group integrated report, the work would be performed by a team separate from the audit team. Exhibit 3. Extracts from consolidated financial statement. Okay, we have we have 4 columns. Okay, the first column is listing of items in statement of financial position. The second column is note, mean the refer some notes of FS, okay? And the third and the fourth column is about the projected figures and actual figures. Projected figures for the year ended 31st December 2008, okay? And actual figures as the 31st December 2007. We also have statement profit loss, okay? And then we have notes to the extracts from financial statements. Goodwill 1. Goodwill relate to group subsidiary and is tested for impairment. On an annual basis, management will conduct the annual impairment review in December 2008. It is anticipated that no impairment will need to be recognized this year due to anticipated growth in revenue, which is forecast for the next 2 years. In March 2008, the group acquired 80% controlling shareholdings in Linco, a listed company located in a foreign country, for consideration of $350 million. Management determination of goodwill rising on this acquisition is shown in Exhibit 4. Other intangible assets. Other intangible assets relates mostly to software and other technological development costs. During the year, $35 million was spent on developing a new IT system for dealing with customer inquiries and processing customer orders. A further $20 million was spent on research and development into robots being used in warehouse, and $5 million on developing new accounting software. These costs have been capitalized as intangible assets and are all being amortized over 15 years useful life. Equity and non-current liabilities. Share issues in July 2008 raised cash of $100 million, which was used to fund capital expenditures. For non-current liabilities includes borrowing of $550 million, compared with $500 million in 2007, and provision of $100 million, compared with $120 million in 2007. Changes in financing during the year have impacted on the group weighted average cost of capital. Information from group's treasury management team suggests that the weighted average cost of capital is currently 10%. Financial performance. 5. Revenue has decreased by 3.7% over the year due to new competitor in the market taking some of the group's market share. And then we have other operating income comprise the following items: reversal of provision, reversal of impairment losses on receivable and other assets, foreign currency gains, profit loss on disposal of non-current asset total. Operating expenses include the following items: staff costs, cost of raw materials, consumables and supplies, depreciation, amortization, and impairment at the operating expense. Exhibit 4. Determination of goodwill on acquisition of Lin. Okay, we have cash consideration paid on 1st March 2008, contingent consideration, total consideration, fair value of non-controlling interest, less fair value of identifiable net assets, goodwill. Okay, note The contingent consideration will be payable 4 years after the acquisition date and is calculated based on the payment of $525 million, only payable if Lin reaches revenue and profit targets outlined in the purchase documentation. The amount included in the goodwill calculation has been discounted to present value using a discount factor based on an 18% interest rate. The non-current controlling interest is measured at fair value, the amount being based on Linco's share price on 1st March 2008. The assets and liabilities acquired and their fair values were determined by an independent firm of chartered certified accountants, Winder Coast, who was engaged by the group to perform due diligence on Linco prior to acquisition taking place. A fair value uplift of $12 million was made in relation to property, plant, and equipment. Exhibit 5 extracts from audit strategy prepared by Future Associates in respect of the audit of Linco. The 2 points below an extract from the audit strategy. At the section of audit strategy including the audit risk assessment have been reviewed by the group audit team and are considered to be satisfactory. Linco is projected to be loss-making this year, and the group audit team is confident that sufficient procedures and going concern have been planned for. Controls effectiveness. We will place reliance on internal controls, which will reduce the amount of substantive testing which needs to be performed. This is justified on the grounds that in the previous year's audit, controls were tested and found to be highly effective. We do not plan to retest the controls, as according to management, there have been no changes in systems or the control environment during the year. Internal control. Linco has offered the services of its internal audit team to help perform audit procedures. We are planning to use the internal auditors to complete the audit work in respect of trade receivables, as they have performed work on this area during the year. It will be efficient for them to perform and conclude on the relevant audit procedures, including the trade receivables circularization and evaluation of allowance for trade receivables, which we will instruct them to carry it out. Để xong phần đề nhé, thì chúng ta xong sang cái phần lời giải này. Đầu tiên là đề người yêu cầu chúng ta phải đánh giá cái audit risk, đúng chưa? Sau đó là chúng ta đến cái audit procedures, đúng không ạ? Cuối cùng là đánh giá cái audit strategy của một cái thằng kiểm toán công ty con là Future Associates. Bây giờ chúng ta sẽ đi vào chi tiết nhé. Đầu tiên là đánh giá audit risk, đúng không? Ở đây chúng ta cần phải viết một cái email để trả lời partner và chúng ta là manager, đúng không nhá? Briefing notes to Maya Craft Audit Engagement Partner from Audit Manager, Subject Eagle Group, Audit Planning. Introduction. These briefing notes are prepared to assist with planning the audits of Eagle Group for the financial year ending 31st December 2008. The notes contain an evaluation of audit risks which should be considered in planning the group audit. The notes also recommend the principal audit procedure to be used in the audits of goodwill which has arisen in respect of a newly acquired subsidiary. The note Then go on to evaluate and extract from the audit strategy, which has been prepared by component auditor. Finally, the group finance director has requested our firm to provide a non-audit service in relation to group's integrated report, and the notes discuss the professional and ethical implications of this request. A. Evaluation of audit risks. Selected analytical procedures and associated audit risk evaluation. We have operating margins, return on capital employed, current ratio, debt divided equity, interest cover, effective tax rate, operating margin, and operating expenses. The group's operating margin has increased from 4.5% to 6.1%, despite a fallen revenue of 3.7%. This is due to a reduction in operating expenses of 4.5% and increase in other operating income of 50%. Return on capital employed has shown a similar positive trend despite fall in revenue. This is an audit risk that expenses are understated, with the reduction in expenses being proportionately more than the reduction in revenue. Within operating expenses, the trends for each component are different. Cost of raw materials, consumables, and supplies has decreased by 3.1%, which appears reasonable given the decline in revenue of 3.7%. However, staff costs have increased slightly by 1.1%, which seems inconsistent with the revenue trend and with the increased automation of operations, which has led to 5,000 staff being made redundant, which presumably means lower payroll costs this year. Expenses could have been misclassified into staff costs in error. Depreciation, amortization, and impairment has increased by 3.6%, which is not a significant change, but will need to be investigated to consider how each element of the category has changed in this year. The most noticeable change within operating expenses is that the other operating expenses category has reduced very significantly. The amount recognized this financial year is only 7.4% of the amount recognized the previous year. This appears totally inconsistent with the other changes noted. It could be the some costs, for example, accrue expenses, have not been accounted for, or that the 2027 figure was unusually high. Other operating income. There's also audit risk that other operating income is overstated. According to the information note 6, during the year, credit of $60 million has been recognized in the profit for reversals of provision. This is 50% greater than the amount recognized in the previous year. In addition, a credit of $30 million has been recognized for the reversals of impairment losses. There is a risk that these figures have been manipulated in order to boost profit as an earning management technique in reaction to the fallen revenue in this year. The risk of management bias is high given the listed status of the group, hence expectation from shareholders for positive growth trend. The profit recognized on assets disposal and increase in foreign currency gains could also be an indication of attempts to boost operating profit this year. current ratio, and gearing. Looking at the other ratios, the current ratio and gearing ratio do not indicate audit risks. However, more detail is needed to fully conclude on the liquidity and solvency position of the group and whether there are any hidden trends which are obscured by high-level analysis which has been performed with the information provided. The interest cover has increased due to both an increase in operating profit and reduction in finance charges. This seems contradictory to the increase in borrowings of $50 million. As a result of this, an increase in finance charges will be expected. This is an audit risk that finance charges are understated. Effective tax rate. The effective tax rate has fallen from 25% to 19.9%. An audit risk arises in that the tax expense and associated liability could be understated. This could indicate management bias, as the financial statement suggests that the accounting profit has increased, but the profit chargeable to tax used to determine the tax expense for the year appears to have decreased. There could be alternative explanation, for instance, a fall in the rate of tax levied by the authorities, which will need to be investigated by the audit team. Consolidation of foreign subsidiaries. Given that the group has many foreign subsidiaries, including the recent investment in Linko, audit risks relating to their consolidation are potentially significant. Linko has net assets with a fair value of $300 million, according to the goodwill calculation provided by the management, representing 8.6% of the group's total assets and 13.4% of group net assets. This makes Linko material to group and possibly a significant component of the group. Audit risk relevant to Linko's status as the foreign subsidiary also attached to the group's other foreign subsidiaries. According to IAS 21, the effects of changes in foreign exchange rates, the assets and liabilities of Linko and other foreign subsidiaries should be retranslated using the closing exchange rate. Its income and expenses should be retranslated at the exchange rate at the date of transactions. The risk of that incorrect exchange rate used for retranslation. This could result in over or understatement of the assets, liabilities, income, and expenses, which are consolidated, including goodwill. It would also mean that the exchange gains and losses arising on retranslation and to be included in the group other comprehensive income are incorrectly determined. In addition, Linko was acquired on 1st March 2008, and its income and expenses should have been consolidated from that date. There is a risk that the full year's income and expenses have been consolidated, leading to a risk of understatement of group profit given Linko is forecast to be loss-making this year, according to the audit strategy prepared by Voucher Associates. Measurement and recognition of exchange gains and losses. The calculation of exchange gains and losses can be complex, and there is a risk that it is not calculated correctly, or that some element are omitted. For example, the exchange gain or loss on goodwill will be missed out of calculation. IAS 21 states that exchange gains and losses arising as a result of retranslation of subsidiaries' balance sheets are recognized in other comprehensive income. The risk is incorrect classification. For example, the gain or loss could be recognized incorrectly as a part of profit for the year, for example, um, included in the $28 million foreign currency gains, which form part of other operating income, which would be incorrect. The amount recognized within other operating income has increased as only $23 million foreign currency gains were recognized the previous year, indicating a potential risk of overstatement. Goodwill. The total goodwill recognized in the group statement of financial position is $1,100 million, making it highly material at 31.5% of total assets. Analytical review shows that the goodwill figure has increased by $130 million during the year. The goodwill relating to acquisition of Linko is $100 million, according to management's calculation. Therefore, there appears to be an unexplained increase in value of goodwill of $30 million during the year, and there is an audit risk that the goodwill figures is overstated, unless justified by additional acquisitions or possibly by changes in value on the retranslation of goodwill relating to foreign subsidiaries, though this later point would seem unlikely given the last side of the unexplained increase in value. According to IFRS 3 business combination, goodwill should be subject to an impairment review on an annual basis. Management has asserted that while they will test goodwill for impairment prior to financial year ended, they do not think that any impairment will be recognized. This view is based on what could be optimistic assumption about future growth in revenue, and it is likely that the assumptions used in management impairment review are similarly over-optimistic. Therefore, there is a risk that goodwill will be overstated and group operating expenses understated if impairment losses have not been correctly determined and recognized. Initial measurement of goodwill arising on acquisition of Linko. In order for goodwill to be calculated, assets and liabilities of Linko must have been identified and measured as fair value at the date of acquisition. Risks of material misstatement arise because the various components of goodwill each have specific risks attached. The goodwill of $100 million is material and to a group, representing 2.9% of group assets. The specific risks arise in relation to the fair value of net assets acquired. Not all assets and liabilities may have been identified. For example, contingent liabilities and contingent assets may be omitted. A further risk relates to measurement at fair value, which is subjective and based on assumption which may not be valid. The fair value of Linko's net asset according to the goodwill calculation is $300 million, having been subject to a fair value uplift of $12 million. This was provided by an independent firm of accountants, which provides some comfort on validity of the figure. And this is also a risk that the cost of investment is not stated correctly. For example, that the contingent consideration has not been determined on an appropriate basis. First, the interest rate used to determine the discount factor is 18%. This seems high, given that the group's weighted average cost of capital is stated to be 10%. Second, the contingent consideration is only payable if Lincoln reaches certain profit targets, đúng không? Given that the company, according to future associates or this strategy, is projected to be loss-making. It could be that the contingent consideration need to be recognized at all or determined to be a lower figure that than that currently recognized based on the lower probability of it having to be paid. The result of the analytical review have indicated that the other side of the journal entry for the contingent consideration is not described as a component of the non-current liabilities, and the accounting for this will need to be clarified, as there is a risk that it has been recorded incorrectly, perhaps as a component of equity. Intangible assets. In relation to expenditure on intangible assets during the year, which totaled 60 million, there are several risks. First, there is the question of whether all of this amount should have been capitalized as an intangible asset. Capitalization is only appropriate when an asset has been created, and specifically in relation to development costs. The criteria from IAS 38 intangible assets must all be met. There's a risk that if any criteria have not been met, for example, if there's no probable future economic benefits from research into the new technology, then the amount should be expensed. There's a risk that intangible assets are overstated and operating expenses understated. There's also an unexplained trend in that intangible assets has only increased by $30 million, yet expenditure on intangible assets according to management information is $60 million. More information is needed to reconcile to expenditure as stated by management to the movement in intangible assets recognized in the group statement of financial position. Second, there's a risk that the amortization period is not appropriate. It seems that the same useful life of 15 years has been applied to all of the different categories of intangible assets. That's not likely to be specific enough. For example, the useful life of accounting system will not be the same as the development of robots. 15 years also seems to be a long period. Usually, technology-related assets are written off over a relatively short period to take account of rapid developments in technology. In respect of amortization periods being too long, there's a risk that intangible assets are overstated and operating expenses understated. Detection risks in relation to Linco. Linco is the only subsidiary which is not audited by BINCO. This given rise to a risk that the quality of audits of Linco may not be the same standard as BINCO, as the future associate may not be used to auditing companies which form part of a listed group and result in increased detection risks at the group level. The risk is increased by the problem with the audit strategy prepared by voucher associates, which will be discussed Part B, which indicate that the audit of Linko has not been appropriately planned in accordance with ACCA requirements. Since our firm has not worked with voucher associates previously, we are not familiar with their methods, and we may have issues with the quality of their work. Therefore, detection risk is high in relation to Linko's balance, which will form part of consolidated financial statement.